Hey everyone, Andy here. Common question I've been getting lately, here we are end of March, we are getting towards the end of the tax return filing season. Common question I've been seeing and hearing is how can I reduce my adjusted gross income, or AGI? Now here we are, like I said, end of March 2022, people are doing their 2021 tax returns and you may see, ooh, wow, my adjusted gross income is higher than I thought it would be, or high enough to the point that it's triggering off something I may not want it to. Like for retirees, things that may come into play are like Medicare premium surcharges, which are based on your level of adjusted gross income plus some adjustments, but typically it's just the same as your adjusted gross income. Or those that are on Affordable Care Act insurance and getting or eligible to get subsidies in the form of premium tax credits. The amount of subsidy you can get is ultimately keyed off your adjusted gross income. Technically it's called the modified adjusted gross income, but it all starts with your adjusted gross income. So you may be doing your return and figuring or looking and saying, wow, my AGI is higher than I thought it would be. What can I do after the fact, in this case, in early 2022, to reduce my 2021 adjusted gross income? Well, first let's step back and look. You have to take a look at the Form 1040, which is the formal tax return we all have to do. There's a link to it in the show notes, in notes to this video. And just super high level, what is adjusted gross income? Well, it's basically all of your sources of income for the year, minus some adjustments. And just to recap quickly, the sources of income: wages, interest, dividends, IRA distributions, or 401k distributions, etc., pensions and annuity distributions, or at least the portion that's taxable. Social Security benefits, again, the portion that's taxable. Capital gains or losses. So if you have stocks or bonds or mutual funds in a regular brokerage account, you sell things at a gain, that's taxable. Or if you sell things at a loss, that loss can reduce your taxable income to some extent. Other income, these are things like rental income, self-employment income, if you got alimony that happens to be taxable, and there's a couple dozen other line items. And then there's adjustments to income. These are things, so all the things I just mentioned are additions to your income other than capital losses if you sell things at a loss. Everything else is additive to your income. This adjustments to income line, which is specifically line 10 on your 2021 Form 1040, adjustments to income are things that can bring AGI down. So this is what I want to focus on right now. Again, early 2022, trying to do your 2021 tax return. You see AGI is high. How can I reduce it? Well, look at the Schedule 1, which is what feeds into that line 10 adjustments to income. And I have a link to Schedule 1 in the notes to this video as well. You can see there's a couple dozen different things that could potentially reduce your AGI. But at this point, after 2021 is already over, what levers do you have to pull? There's really not a lot. Frankly, there's only two that may apply to you or most people. One is a health savings account deduction. If you have a health savings account, you have a qualifying high deductible health plan, not Medicare. Medicare doesn't apply, so this only applies to someone under 65. If you have a qualifying high deductible health plan that has a health savings account attached to it, you can make a contribution to a health savings account, and you can do it after the end of the calendar year. So here we are, early 2022. You can still make a 2021 health savings account contribution that can reduce your 2021 adjusted gross income by no more than the maximum contribution for the year, which depending on your age, it's like I'm rounding, I think $3,600 or $4,600 if you're single. Basically double that if you're married. The only other lever you can pull after the calendar year that I'm aware of is an IRA deduction. Again, this is something you can make in early 2022 to apply for 2021. So if you were eligible to make a deductible IRA contribution, then you can still contribute now up to $6,000 if you're under 50 or $7,000 if you're 50 or older. You can still contribute now for 2021. That will reduce your 2021 AGI. Now there's a few qualifications. You need to meet. One, you had to have had earned income for 2021, or if you're married, your spouse needs to have earned income. And your total amount of gross income couldn't have been over a certain level. If it was, then you can no longer take a deduction for your contribution. And there will be a link in the notes to what the levels are for 2021. So those are really HSA deduction or HSA contribution and IRA contribution are really the only two things you can do after the end of the calendar year to potentially retroactively reduce your AGI, for that calendar year. What if now, other example, we're still in the end of 2021, right? So there's still some calendar year left. and you're monitoring your AGI throughout the year, you realize it's higher than you thought it was going to be or higher than you want it to be, what can you do? Well, now you basically have to go back and look at all the line items that go into your AGI. Again, wages, interest, dividends, IRA distributions. So let's pause there for a moment. Wages, interest, and dividends, you can't really stop or turn off, or at least kind of, you might be silly to, because you'd be giving up $1 of income to save yourself whatever 30 cents in tax, whatever your effective tax rate is. But even that aside, I mean, it's probably functionally hard to just stop wages unless you quit, but that's probably an overreaction for trying to manage your adjusted gross income. IRA distributions, that's something you can control, unless you have a required minimum distribution. You're 72 or over, and the government forces you to take out a certain amount. That's a different story. But if you're younger than that, you can control how much you do or don't take out of your IRA. So maybe take out less if you can, before the end of the year. Pensions and annuities, same thing. Well, once those are on, you can't really turn them off, or you'd be silly to turn them off, so you can't control that lever. Social Security benefits, similar story. Once they're on, you probably don't want to stop them just to try to save yourself some tax. Capital gains or losses. This is where you definitely have some control, possibly. So recall I said if you have a regular taxable brokerage account that owns stocks, bonds, mutual funds, whatever, and you have things that are at unrealized losses, so the current price is less than what you bought it at, you can sell that thing, realize that loss, and that realization of the loss will reduce other taxable gains you already had for the year. Or if you don't have any other activity, you can reduce your total income by up to $3,000. So you can realize up to $3,000 of loss. That realization will reduce the rest of your income, your wages, your whatever, by up to $3,000 in total. There's some exceptions, but generally it's $3,000 per person, or per return at least, I should say. That's really it. I take that back. So that's it. Again, if we're still in 2021, you can potentially harvest some of your losses in your brokerage account to reduce your income some. Or if you go back and look at Schedule 1, you can look at the other items of additional income or even the adjustments to income. Again, a lot of these things may not apply to you. There's a few dozen different additions and adjustments to income. Just take a look and see. Just looking at one adjustment, for example, if you're a teacher, you can deduct up to $250 of unreimbursed expenses you paid for supplies or materials for your classroom. Now, it's not going to move the needle much. That's $250, but still, it's something. If it applies to you, it is one way to perhaps reduce your AGI some. So just take a look at that. This is really the answer of how can I reduce my AGI? Look at Schedule 1. The first side of Schedule 1 is all the things that are included in your income. See which one of those you can change, if any, apply to you. The second part of Schedule 1 is all the things that reduce your adjusted gross income. See which one of those may apply to you and see if you can take advantage of it perhaps. All right, that's it. Hope you found this helpful. I will see you next time.